Good morning, everyone. Welcome to this rundown for global stocks and commodities for the 29th of July. It's fairly normal to see the market go through sector rotations every few months. And undoubtedly, over the last 3 or 4 years, the technology sector has been one of the real market leaders. And I'm not saying that that is necessarily going to change, but certainly through the week with some fairly significant downward price moves in a lot of the technology names, it just does bring into question whether the technology sector might just take a bit of a breather, go through some consolidation for a few months, and as a consequence of that, in an overall bullish market where earnings have been really good, then that money has to flow somewhere else. And so I'm very much attuned to other sectors starting to kick in, and I'll talk a little bit more about that in due course. So let's jump in and have a look at the week that was. Obviously, a big week of earnings, and this is what I had last week. That sector rotation is always in play, and certainly that was the case. And we are seeing some evidence of new leadership, and probably the US financials and US industrials are probably the two areas of most interest at the moment. We'll have a look at the normal commodity and stock trends. And last week there wasn't a portfolio analyst edition, one of the 4 weeks of the year that I take a break, but portfolio analyst will certainly be back this week, and we've been zeroing in on a lot of very good outcomes. American stocks, the S&P rose 18 points on the week, despite a move back on Friday night, so 0.6% gain for the week, and we broke out above that 2,800 point level. But there certainly was some evidence on Thursday and Friday that the NASDAQ and the Russell 2000 that have been the leaders, unquestionably, are starting to lose some leadership. Particularly the Russell 2000 looked a bit weaker on Friday. And I'm not expecting that they're going to do any sort of major reversal. I just think that this is the start of a consolidation that is inevitable. And we get a few months of consolidation and we set up for the next run higher, because I don't see anything that is really going to change that outlook. The earnings are just too good at the moment, and the US economy is too good for it to be anything otherwise. Now there was some, I say, perceived poor outlooks for Facebook, Twitter, Intel, and PayPal. If you look at the results were all extremely good. They beat on top and bottom line in almost every case, and they experienced very, very strong growth from the year before. But there were some comments made that the market has seized on about the next quarter. And with respect to Facebook, which is probably the most high-profile one, they're indicating that the growth in user numbers may drop. So not that the user numbers may drop, but the growth quarter on quarter may drop. And now the market seized on that and absolutely smashed the stock down by around 14 or 15%, which seems like a ridiculous overreaction. But nevertheless, I wouldn't be jumping in and buying Facebook just yet, because sentiment might take this a bit lower. But when I look at the results of all 4 of those stocks, they were all pretty good. They beat expectations and they showed extremely strong growth, but the market was just in a position where any sort of disappointment at all was always going to be dealt with very, very harshly. And I think this just sets up buying opportunities, so I'm not perturbed by that at all. Q2 earnings are still as good as ever. There's a record number of stocks that are beating on the earnings line. Earlier in the week, it was sitting at around about 90% of S&P stocks that had reported. Now, that was only a relatively small number, but most of them had beaten expectations, and expectations that had already been raised. So this is again another incredibly impressive performance from the American stock market, and they're certainly meeting the 20% quarter-on-quarter growth objectives that had been set. Now, the GDP result also came in at the end of the week, and it was the best GDP result since 2014. Headline rate of 4%, but the Americans do all sorts of weird and wonderful things with the way they report statistics. So my understanding is that that really should be looked at more as a 3.1 to 3.2% rise annualized. But nevertheless, that is a very powerful result, and things are going along really well in the States from an economic point of view. Now, the US dollar didn't do much. The media is trying to beat up a currency war, but frankly, the currencies really are just bobbing up and down, and they're not really doing all that much. Let's take a look at some charts, and we'll start first of all with the S&P. And I've put this on a weekly chart to start with because I think sometimes it's easy to get a little bit too close to the price action. And the reason I put this on a weekly chart is just to show you the orientation of the various moving averages. So from the red line at the bottom, this is the 200 week, and then we've got the 100 week, and then the 50, and then in green we've got the 20 week. And you can see that other than a bit of a dip in the 20 week, we've still got these three major moving averages are all still fanning out. They're not closing up at all. Now, okay, these are, a 50-week moving average is that's effectively 1 year. So that's a pretty long time frame. But on a big picture level, there is absolutely nothing that has interrupted the upward trend. And the price is still above all three of them, including the 20-week moving average. So there is no way that you can possibly conclude that we're seeing weakness in the market at the moment. Now I'll just switch back to the daily, and I'll just get rid of a couple of these just to tidy the chart up a bit to what it normally looks like. Okay, so this is the chart view that you normally see, and there's the long-term trend that started in 2017, and you can see that other than a whole lot of excessive fluctuations, which is really settling down, that basically this year, although it seems and feels horrible, we're still basically on trend from 2017. Now, the other key thing that happened, of course, through the week is that we did manage to break above 2,800 points. Didn't quite make it to the all-time highs, up at 2,873, but no surprise to see a bit of a pullback. So the S&P still looking very strong at this point in time, but certainly, so that encompasses all sections of the market. But we did see a larger pullback in the NASDAQ. So this is the QQQ. Again, still on trend, still on long-term trend, but had got a bit further ahead of itself than the S&P had. And as a consequence, Friday was a stronger pullback due to those earnings reports from Facebook and Intel, etc. And let's look at the Russell. So there's the Russell. Now, you will recall that the Russell had been unquestionably leadership. We'd broken out earlier than the S&P. We'd broken out in May to new all-time highs, whereas the S&P still hasn't done that. So impressive leadership from the Russell, and it's continued to hang up there, but we are certainly getting a consolidation. Now, the important thing with the Russell and for the breadth of the market is that we don't get a break of this level here, which is around 162 on the IWM. That's the ETF that tracks the Russell. So at this stage, we can say that we've probably got a consolidation, and that would be normal. So nothing new there. And we'll see how that one plays out. Now, just to highlight a couple of other key sectors. Let's just look at energy. So this is the US Energy ETF, and it's still holding up there pretty well. Hasn't really broken out as I would have thought it might, but it's still looking pretty solid. So despite the fact that oil was down a bit over the last couple of weeks, the stocks have held up pretty well. And this is the overall index. So there are literally thousands and thousands of stocks within this, and there's a lot of big cap stocks. So there's a lot of stocks here that contribute to this. But once you drill down into individual industry groups within this, there is an incredible spread of performance. And there are some stocks that are doing extremely well within this overall ETF. The other one I want to look at is the finance sector. Now, again, this breaks down into something like 17 or 18 different industry groups and literally thousands and thousands of stocks. It's been languishing, but it's still overall in a big uptrend. So it's looking to me like we might be, if we're going to get some sector rotation, then now would be the time to do that. So let me just put a bit of structure around this. So we've been in a consolidation now since the start of February. That's the range that's been established. We've had a little bit of an overrun down here in early July, but that's quite normal. It happens a lot. And from there, we've started forming higher highs. So we've got 1, 2 higher highs, and then we've got higher lows as well through here. So we are starting to see an uptrend in US financials. And given the results that have come out from JP Morgan, from Citigroup, from Bank of America, they've all been pretty solid. So I wouldn't be at all surprised to see the finance sector continue to work its way upwards. Now, turning to the US dollar, not a lot of change. You can see we're just getting a big consolidation after this big surge up here from 89 up to 95, and now we're getting quite a lot of consolidation. But that consolidation is within an upward sloping channel. So one would have to say that this resistance here at 95.2 is likely to break, and we're likely to see a continuation of that uptrend. So what does that mean for the Australian dollar? Well, we're getting the same sort of consolidation, but on the downward slope, and you'd have to say that the next move for the Australian dollar is probably down to support just under 72, and then we've got further support down under 69. And if we take a bigger picture view, you can see where the Australian dollar has been over the last decade. So we set lows here after the GFC down around 60, 61. We then went to $1.10 in 2011, and that's when the commodity boom finished, and it's been pretty much a downhill slide since then. A big consolidation. We got a little bit of a couple of little blips up to 80 when particularly when iron ore surged back, but the outlook for iron ore is not looking all that flash at the moment. So I think there's every chance that we test 71 and then quite likely 68. I think that's the long-term direction for the Australian dollar. Now, while I'm here, let's look at the ASX 200. So we've now broken out above 6,000 points. I'm surprised by this, I must say. I didn't think that we would have enough grunt in the Australian banks to get the index up there, but clearly the Australian banks are still being supported. And so we're up basically right at 6,300 points on the ASX 200. So just to recap, so the Aussie dollar slightly lower to 74, and our index rose by another 17. Outside of the fintech stocks that I've been talking about periodically, which have just been stunning performers, there's very little in the way of sustained sector trends. This is just so much a stock picker's market. you can't sort of throw a blanket over a sector of the market and say that that sector is, or that group of stocks is doing well, because there's hardly any of that happening. It's very much about picking individual stocks. Turning now to precious metals, gold was down another 7, so it's really, really languishing. Wasn't that long ago that I was looking at the possibility of a rising trend channel and a break of 1400, and now 1200 is very much in play. And there's two reasons for that. In a rising interest rate environment, gold is just less attractive. There's less reason for owning it. And secondly, of course, the rising US dollar is not helping at all. I think for gold to get any sort of momentum, we need a strong dose of fear over something, or we need a dose of inflation, and we're not really seeing an inflationary breakout yet either. People have been talking about an inflation breakout since 2012, since all the stimulus, and it was been conventional wisdom that because you can't pump that amount of money into the world's financial system and not create inflation. And here we are 6 years later, and we're still struggling to get inflation much above 2%, and that's only in a few isolated places around the world. And a good reason for that is because of technical innovation. It's been such that it's really taken the pressure off wage growth, even though unemployment levels are relatively low. We haven't seen wage growth either in America or in Australia, and it's hard to see what's going to change that. Precious metal stocks, GDX down again, and it's really looking pretty sad. So let's look at the daily first of all. So a bit of up and down. We hit a low of 12.12 through the week. But if we look on a weekly basis, you can see that we've clearly broken that that uptrending channel now. So here was the channel that we were in, higher highs and higher lows. We broke that on the end of June. So basically 4 or 5 weeks now out of the trend channel, every week finishing lower, and the outlook for gold is not too flash. Turning now to GDX on a weekly chart, you can see we're still in this very, very lengthy sideways well, I'll call it probably a distribution zone now. I've been calling it an accumulation zone because I felt that the next move was likely to be to the upside with gold, but this is now looking really quite shaky. And this range really started at the end of 2016, so we're 19 months into it, and you can see now that we are starting to get lower highs. Haven't got lower lows yet, but I wouldn't be surprised to see a breakdown of this particular pattern. So the US gold stocks, global gold stocks, not really a place to be. However, Aussie gold producers are generally doing very well. Now, the results over the last week or two have been a bit mixed. A couple of the majors, like Evolution Mining, have been marked down to a reasonable degree, but some of the others, some of the very best of the Australian producers, like Northern Star, continue to basically trade near all-time highs. So looking very positive. Other commodities, copper was very slightly stronger to 285. Crude oil didn't do much, stayed around the 68, 69 mark. And as I pointed out at the start, the stock index is really showing some relative strength, considering that the crude oil price has come back. Just so many opportunities within this group. It really is a pretty good hunting ground, I think, but with an emphasis on buying the dips. There's the spot copper chart. Crude oil over 3 months, not much change in the last week. So to bring it all together, I think it's reasonable to expect some short-term consolidation. The market has broken 2,800 on the S&P, which is important, and it's bullish. but hasn't been able to break the all-time high, and so I think we might just get a bit of a pause here. But from my perspective, looking at the earnings, looking at the GDP growth, looking at the other economic indicators, buying dips in stocks that are already in strong uptrends, I think is probably a pretty good thing to do. Earnings are strong. Market breadth remains near all-time highs, so there's no breakdown in the breadth. The industrials and financials look appealing, and we might just see technology take a bit of a breather. So if that helps you get focused on where the possibilities might be, then that's a good thing. Portfolio analyst this week. With a week off, I haven't really turned my attention to it, but there's just opportunities all over the place. So I'm sure there'll be some very interesting and positive things in market analysts this week. There's my contact details for any non-members, and we'll be back with you again next weekend. Cheers.